Hold on tight. The global oil market just took a dramatic turn, shaking up both investors and political leaders alike. After Israel launched a strike targeting Hamas leadership in Qatar, and former U.S. President Donald Trump pushed Europe to slap hefty tariffs on Russian oil buyers, oil prices saw an uptick. But here's where things get complicated. The gains were modest, and a shaky economic outlook quickly tempered investor excitement. As of early Wednesday, Brent crude futures edged up by 35 cents, about 0.53%, reaching $66.74 a barrel. Meanwhile, U.S. West Texas Intermediate rose by 36 cents, or 0.57%, to hit $62.99 per barrel. These increases may seem notable, but let's put it in perspective. Both benchmarks spiked by nearly 2% immediately after the reported Israeli attack, only to settle back when U.S. officials reassured Qatar that such an incident would not be repeated on its territory. This is the part most people miss. Geopolitical shocks often trigger momentary market surges, but sustained trends depend on deeper economic realities. And here's the controversy. Prime Minister of Qatar warned that the Israeli strike not only increased regional instability, but also put sensitive peace negotiations with Hamas at risk. Is escalating military action really the path towards lasting peace, or just a recipe for more turmoil in the Middle East? Meanwhile, Donald Trump isn't sitting on the sidelines. He's calling on Europe to impose a whopping 100% tariff on oil imports from countries like China and India. The aim? To choke off Russia's financial lifeline, which has largely been kept alive by oil sales to those nations, despite Western sanctions, following Russia's 2022 invasion of Ukraine. However, as IG market analyst Tony Sycamore notes, skepticism about how far these measures will go and whether they'll actually happen has kept oil prices from making a bigger leap. Crude oil remains susceptible to downward pressure given the ongoing market weakness and doubts about U.S. follow-through on sanction threats, Sycamore commented. And this is the part that could get heated. If secondary tariffs really do start hitting big players like China, analysts at Leseg say we could see a serious disruption of Russian oil exports, potentially tightening supply worldwide, a classic recipe for price hikes. But with so many unknowns, the big question hangs in the air. How aggressive is the U.S. administration prepared to be? Overplaying their hand could fuel inflation and tangle with efforts to persuade the Federal Reserve to lower interest rates. Speaking of the Fed, many traders expect an interest rate cut in the upcoming meeting. This could provide a boost to the economy and push oil demand higher. Yet fundamental challenges remain front and center. According to the U.S. Energy Information Administration, rising crude inventories, thanks largely to OPEC Plus stepping up production, are likely to keep global oil prices constrained over the coming months. What do you think? Are these policy moves really going to break Russia's oil dominance? Or do they risk stoking broader economic problems? Do military actions like the recent Israeli strike simply prolong the conflict? Or are they a necessary step? Dive into the comments and let's hear your perspective. Do you agree, or do you see things differently? The floor is yours.